Good afternoon, everyone. Welcome to our 2024 Market Preview webinar. Over the next hour, we'd like to share our thoughts on what we're watching for 2024 across the different capital markets, as well as a brief summary of what happened in 2023. And before getting into the material, the normal housekeeping items. We're here to answer questions that are on your mind. We have received some questions ahead of time, but we will do our best to answer every question that is asked this afternoon. So please do use the Q&A feature to submit any questions that are on your mind. If we do not get to them in the time allocated today for the webinar, we will do our best to reach out directly to individuals to answer the questions. This will be recorded and uploaded to our YouTube channel, so if you are so moved, please feel free to go back and rewatch or share with colleagues. In terms of introductions, hopefully by now, those of you who've joined us in the past, I'm a familiar name and face and voice. My name is Greg Nienberger. I'm the Director of Research here at Marquette. I will host the webinar as well as discuss the U.S. economy section. Joining me today are our lead analysts across all the asset classes that we follow. Frank Valley will cover fixed income. Catherine Hilliard and David Hernandez will review U.S. equities and non-U.S. equities, respectively. We will then transition to the alternatives portion of this afternoon's webinar. Evan Frazier will discuss hedge funds. Griffin Gilday will review real assets, which consists of real estate and infrastructure. And then finally, our private markets team. Haley McCollum will cover private equity, while Chad Schaefer will cover private credit. Now, before we get into the capital markets, let's start with the U.S. economy. And by far, the big story of 2023 was the drop in inflation. At this point, inflation is not quite at its 2% target, or the Fed's 2% target, but it has reverted meaningfully down towards that goal. It's expected to stay at this level over the course of 2024. Now, of course, one of the knock-on effects of that is that the Fed will no longer have to increase rates to fight inflation. In fact, expectations going forward for this year is that the Fed will cut interest rates. And one of the dynamics to watch, which all of our asset class analysts will cover in their comments, is the idea of the Fed pivot. And as the Fed moves from rate hikes to rate drops, how quickly do they actually drop rates and in what magnitude compared to what the market is expecting? The market is expecting 5 to 6 cuts over the course of this year with an ultimate Fed funds rate of 3.9%. Whether that happens in reality versus what market expectations will certainly govern the performance of asset classes. Now, it's not just rate cuts we're watching. We're also watching the consumer, and in particular, the level of borrowing, the level of debt that consumers are taking on. U.S. consumers have kept the economy out of recession so far, even though there is some thought that perhaps we would see one in 2023. If consumers can continue to spend, that should keep us out of a recession. But the worry is as consumers take on more debt, they'll spend more of their disposable income paying down debt rather than consuming new goods and services. Big picture macroeconomic outlook. Where do we see things falling in 2024? The Fed funds rate, as we just talked about, is expected to come down. While it may not come down all the way to 3.9%, it should be lower than where it is today. GDP, baseline expectations that GDP will stay positive. However, it will be at a lower overall level than what we saw in 2023. Unemployment rate will stay mostly steady. The most recent measure of unemployment was 3.7% in December, with 216,000 net new jobs added. We do think the net new jobs added will fall a bit during the year. Unemployment rate will stay about where it is. And then inflation, we talked about this earlier, inflation is approaching that 2% target. It may not reach all the way down to 2% for 2024, but it should stay somewhere in the 2% range, 2 to 2.5% range. So that's the outlook on the economy, more good than bad. We think GDP growth does stay positive, but it will be at a lower level than we saw in 2023. And again, a lot of this does hinge on the consumer and the consumer's resiliency. Now, let's move on to asset classes. We'll start with fixed income again. The easiest link from the U.S. economy and Fed policy is fixed income. Frankly, it was a little bit of an up and down year. We went into 2023 thinking fixed income was all but a guarantee to deliver positive returns. That was very much in question until the fourth quarter played out. So tell us a little bit about what you saw in 2023, as well as what you're watching for in the year ahead.
Sure. Thanks, Greg. So coming into 2023, we, like a lot of other market participants, thought that bonds were going to be back. It was a little bit of a rocky road, but all in all, it ended up being a pretty good year for fixed income. The aggregate was up 5.5% in 2023. Another area we liked was high yield over bank loans in the below investment grade space. That turned out to be a little bit of a rocky road as well, as loans were performing better than high yield for most of the year because of higher base rates as Fed fund rates continue to push up, which also helped push LIBOR up, which helped loans. This really turned in the fourth quarter when we saw that market sentiment shift and high yield ended up outperforming loans by the ever so slightest margin of 13.4 to 13.0. Looking at the performance over the year, that 5.5% return wasn't linear. The year started out well, but when the market sentiment shifted to higher for longer, that pushed total returns negative. The ag had never had 2 straight years of negative returns until last year, but midway through October, we were looking at 3 straight calendar years of negative total returns. Luckily, we caught a little bit of a Santa Claus rally, and the ag rose about 8% from mid-October through the end of the year to finish at that 5.5%. So what really drove that performance in the in the fourth quarter was falling treasury rates. We saw rates get pushed down across the curve, which was good for bonds. Turning ahead to 2024, bonds are still back. Fixed income yields remain elevated. The yield on the ag is at 4.5% as of year end. It pushed up a little bit higher year to date, but as of year end was sitting at 4.5%. Just for a little bit of context, at the start of last year, not last year, at the start of 2022, the yield on the ag was 1.75%. So we've come quite a long way. Elevated treasuries have made the all-in yields look attractive for bonds. However, the spreads are fair at best. Most markets are trading at or near their long-term averages, and some even inside. Particularly in the corporate credit markets, spreads are very tight. One area that we do like is mortgages, which are at long-term averages, and those are trading a little bit wider than a lot of the other markets and a lot wider than they have in the recent history because of the increased rate volatility. If we do see that rate volatility fall, we should see spreads tighten in a little bit. On the next point I wanted to make is around Fed funds. So Fed funds has been something that we've been watching for a long time, and the market's been watching, and for a long time we've thought about this pivot and when is this pivot going to happen. As you can see on the chart, in 2023 we thought that we were going to see that pivot, probably because there was a recession. That's since been pushed out, and now here at the end of the fourth quarter we're fully pricing in some rate cuts. At the end of the year, the first rate cut was expected in March, and then to see a rate cut at every meeting through the year end. It's come off a little bit now, looking more like a May, but we probably do think that's a little bit overly aggressive. Looking here at spreads are tight, but spreads are tight for a reason. You've seen in the below investment grade space, default expectations tick up a little bit, but they're actually doing a little bit better than expected. So in 2023, the defaults came in lower than were expectations. In 2024, that expectation has been revised down, and all in all, they remain below historical averages. So to wrap things up, where do we see risks and opportunities? First off, bonds are still back. After years of low interest rate environment, bonds are actually offering some compelling yields. Within fixed income, a couple areas that we like are agency MBS. It still has some decent spreads because of high interest rate volatility. You could see those spreads tighten if that rate volatility falls. The next area that we do like is investment grade corporate credit. Corporate credit gives you a nice carry, so a little additional income added into your portfolios. Those corporate credits do have strong fundamentals. A lot of those companies took that low interest rate environment of a few years ago and locked up their borrowing. So they've borrowed at ultra low rates. They've got some increased income coming in through higher inflation, and so it's transferring to the bottom line. Some risks that we're seeing, first one is really a big one, and that is there going to be an economic downturn here in 2024? A lot of people thought there would be one in 23, so does it get rolled forward to 24? Fed fund rates are up 5.5%. One thing that Chairman Powell has consistently said is those rate hikes act with a variable and lagged effect. So if that lagged effect does hit the economy, you could see spreads widen. Right now, the market's fully pricing in a soft landing, so those spreads are very tight. If you do see the economy wobble, you'll see those spreads widen. The next thing is the aggressive rate cuts are already priced into the market, so everybody really believes that those rate cuts are going to come. If they didn't come in March, but now if they don't come in May and cut through the entire rest of the year, that's going to be bad for fixed income. So if those rate cuts are slower or later than is expected, it'll be a negative. And finally, there's a lot of wild cards here this year. So 2024 is shaping up to be a pretty wild year because first thing is the budget. It looks like since we published this deck, we do have a temporary budget that's going to fund the government through March. But we've got the whole rest of the year, so there'll be plenty of infighting and saber rattling to go along with that. The next thing is we're going to have a contentious presidential election. After the New Hampshire primaries this week, it's shaping up to be a Biden versus Trump #2. So there'll be even more saber rattling there. And probably the last one is the U.S. is involved in 2 wars. So any increased volatility around those topics could go over to volatility into the market.
And Frank, as I step back and take a really big picture look at the fixed income market, the theme is really, as you mentioned, the same as last year, that bonds are back and the absolute level of yields, then the income they generate should offset any type of adverse price movements from bonds across most scenarios, whether rates go up some or when rates go down, usually that's beneficial for bond prices anyways. But the absolute level of income should really drive positive returns in almost every scenario for the year ahead. So that's fixed income in a nutshell. Let's move over to equity. Equities were a volatile bunch in 2023. A lot of disparity between growth and value, some concern over index concentration, the Magnificent Seven. So, Catherine, I'll stop talking here and let you take us through not only what happened, but what you're watching for in the next 12 months.
Thanks, Greg. I would say markets surpassed most people's expectations in 2023 as domestic equities closed the year on a high note, with all major indices posting double-digit returns. Similar to the volatility Frank mentioned in bond markets, though, the quarter was not as smooth as the slide would suggest, as all indices notched negative returns in October as rates continued to rise, peaking at 5% mid-month. At the end of October, value indices across the market cap spectrum were in negative territory, with small cap equities faring worst across the spectrum. The S&P 500 and Russell 2000 hit a low on October 27th, with the Russell 2000 being a low for the year, but we're off to the races from there as supportive economic data and more dovish Fed rhetoric following the meeting in December led to exuberance in the market, and investors anticipated multiple Fed cuts, as Greg and Frank have both mentioned. Now, looking closer at performance in the fourth quarter and 2023 as a whole, small cap value led the charge with a 15.3% return in the fourth quarter. If you remember back to the first quarter, small cap value underperformed amid the fallout of the Silicon Valley Bank collapse, as the index holds an almost 18% weight to banks. In the fourth quarter, this weight was actually a positive, as investors began to price in the likelihood of falling rates and banks outperformed, supporting strength in that small cap value space. Further up the market cap spectrum, growth equities outperformed, which, as we can see from the chart on the right here, was really much the story for 2023. And so not surprisingly, with that growth outperformance in 2023, you saw those technology, communication services, and consumer discretionary areas of the market outperform. But in a potentially positive sign for markets to close the year, we saw market breadth emerge in the fourth quarter. Value-oriented sectors like real estate and financials, which were supported by the suggestion of Fed rate cuts in 2024, showed strength alongside those growth-oriented sectors that have led for much of the year. And the phrase Magnificent Seven, which has been thrown around so much this year, and with good reason, in the first half of the year, this area of the market, these 7 companies truly did drive the market higher. And that level of outperformance really supported the S&P 500 for the full calendar year. But if you look at the back half of the year, shown through 3Q and 4Q in the middle of the chart here, the small cap equity space actually did outperform the Magnificent Seven in the fourth quarter. And for the full year in 2023, small cap equities outperformed the S&P 500 x these Magnificent Seven companies, showing further signs of market breadth in the back half of the year. So given the strength in the Magnificent Seven, concentration risk did become a concern, and it's something we did talk about on multiple webinars earlier in the year. And while the Russell 1000 growth remains at historic levels of concentration at about 47%, the NASDAQ did make concerted moves to reduce its exposure, once with its special rebalance in the middle of the year, and again in December at its annual rebalance. Considering the prior periods we've seen of this level of concentration, if the economic environment stabilizes, you may continue to see this broadening out of market and the potential for capital to flow out of these companies. If this does in fact occur, the equal weighted index or even small cap equities may be beneficiaries. And considering small cap equities comprise only 4% of the US equity market, measured by the Russell 3000, there is room for growth in that space. So looking at factor performance, this largely reiterates what I've already kind of mentioned on the webinar. Growth and quality led in 2023, but size was a key factor as we closed the year. So as everyone knows, and as has been mentioned, it is a presidential election year, so I'd be remiss not to touch on how equity markets have been affected by presidential election years. And as we can see here, going back to 1984, in presidential election years, equity markets have been generally positive, with the notable exception of the global financial crisis. And so on a few of our past webinars, we have spoke about what's driven outside of the Magnificent Seven and including that markets in 2023, and this was largely multiple expansion. And we can see that very much here as earnings growth was challenged overall, and the S&P is only expected to show slightly positive earnings growth for 2023. On a positive note, though, current estimates suggest the outlook may be improving, especially within the healthcare and technology sectors. And although it's not shown here, it may not be surprising given the level of relative performance for small cap equities. Small caps will post likely negative earnings growth for 2023, but estimates for 2024 are notably more positive and currently sit at about 25%. So looking at valuations, although markets were positive across asset classes in 2023, we did see that relative underperformance we've mentioned from small cap equities and from value underperforming growth. So the story hasn't really changed here in terms of what we're seeing as attractive from a valuation perspective, as we still see small cap and value-oriented equities as attractive. So we've touched on most of the risk and opportunities already, and similar to the risk Frank's mentioned, the risk from a geopolitical standpoint alongside the number of elections being held around the world in 2024 may bring volatility to the equity markets as well. And on top of this, the rally to close 2023 may have priced in too high of expectations for the number of Fed cuts in 2024. So the correction that we saw to begin this year, especially among small caps, may be reasonable. We've spoken about the attractiveness of small caps from a valuation perspective for multiple webinars, and it is still listed here in the opportunity section. But at the same time, large caps do continue to reach all-time highs. Lofty valuations among these companies may pose some risk if you see any hiccup in earnings, but for now, the large cap technology companies largely seem to be able to continue to post better than expected earnings results. But given the moves higher that we have seen in the S&P, if the Fed, and as Frank also mentioned, if the Fed doesn't cut rates as soon or as at the rate markets are expecting, we could see potential risks to the equity markets and a potential sell-off.
So Catherine, again, some of the same themes that have really been mentioned every section now with actual versus expected rate cuts. You got an election, geopolitical issues and conflict, and of course, not just elections here in the United States, but elections abroad as well. So nice take on all those. And then let's kind of go overseas. And David, what do you see on the non-U.S. equity side?
Well, 2023 was a strong year for public equities. All major global equity benchmarks produced double-digit returns. Now, some of our listeners, especially those with a high attention to detail and that follow the markets pretty closely, are going to look at the middle of this table and say, hey, the EM index actually returned only 9.8%. I thought you said it was a double-digit return. And that's very accurate. And I did take some rounding liberty with my leading statement. And I'm glad y'all noticed this because we're going to talk about EM specifically and the interesting country return variability that has occurred there. Now, we use this country performance chart that maps out the country returns on a quarter to date and annual basis. And it lists out 14 countries, which is a mix of developed as well as emerging markets. And of the 14 countries that we list, there's only one that generated negative returns, and that was China. Now, later on in the slide, I'll tell you specifically how much China lost. But for now, I want to point out that there were 3 countries, emerging market countries, that were in the top 5. You have Mexico, Brazil, Taiwan. They all generated returns north of 30%. Italy and Spain also rounded out that top 5 with returns north of 30%. When we think about 2024, this performance divergence between China and other EM countries is a theme that we are watching, and we'll classify this theme as emerging markets beyond China. Now, we have 3 other themes for 2024, including geopolitical uncertainty, increased focus on Japan, and lower interest rates. So from here, I'm going to touch on each of these themes and discuss some of the potential impacts for investors. So first, interest rates. We've already spoken about interest rates, and investors expect, and they're hoping for interest rate cuts here in the United States as well as other parts in the world. And that is a possibility because we've seen global inflation fall significantly over the last 4 years. So the 8 major economies listed on this page have a better handle on inflation compared to COVID peaks. Now, we ended 2023 with a sharp rally in risk assets as many investors were betting on U.S. interest rate cuts sooner and faster. So lower interest rates will be important to watch, specifically the difference between market expectations and reality. And we think that will have an influence, as Catherine said, on equity returns this year. At this point, there may be some more risk to the downside, given that expectations were so far ahead and headed into 2024, we're probably overly optimistic. Now, our second theme for non-U.S. equities is Japan in focus. I was born in 1980, so I consider myself a child of the 80s. I remember things like Cabbage Patch Kids, He-Man, Rainbow Bright, Care Bears. My favorite activity from the 80s, though, was chasing down mushrooms and fighting disgruntled turtles. If you don't know what I'm talking about playing Super Mario Brothers from Nintendo. And if you were a child in the 80s, you probably spent a lot of time playing Nintendo. If you were an investor in the 80s, you probably spent time focused on Japanese equities. If you look at the MSCI Japan Index, they had a tremendous decade in the 80s where they generated an annualized return of 28.4%. Over the next 2 decades, though, it fell off of investor radars as that country kind of muddled through a deflationary and low growth environment. But this decade and more recently, there's been more attention given to Japan. Over the last 18 months, what has happened is there's been a renewed focus on corporate governance as well as shareholder return, and that has caught the market's attention. Now, this coupled with an improving inflationary outlook helped push the MSCI Japan Index to a return of 20% in 2023. Now, based on our conversations with investment managers, this could be a market that continues to demand investors' attention. Now, another market that has demanded attention, though for negative reasons, has been China. At the beginning of this section, I promised I'd tell you how much China lost. Well, China lost 11% in 2023. In the country performance slide, I highlighted 3 EM countries that were top performers. So it's probably not a surprise to see that the EM, excluding China index, generated a 20% return for 2023. And that's 31% above the MSCI China index. Now, there are several reasons why EM ex China has done so well. One of those reasons is there are several EM countries that are benefiting from changes to global supply chains. You think about trade with the US and China, and that's down since 2018, but trade with the US and other EM countries is up. You can think about countries like Mexico, Vietnam, Taiwan, Korea as well. Additionally, you can think about India as being a country that has benefited from increased infrastructure spending, government reforms. There's a lot of positive sentiment there. You can also think about Korea and Taiwan being countries that can benefit from AI themes with their heavy exposure to tech hardware. So there's a lot of positive momentum. There's growth prospects that are happening. So while China has been a tough market, much of the rest of EM is a different story. Now, when thinking about China, I think the story there can be summed up with the chart on the right. So the Chinese consumer has not rebounded from the last round of COVID lockdowns. Now, starting in 2023, experts expected a robust economic recovery led by the consumer, but that didn't happen, and consumer confidence remains at historical lows. Now, the Chinese government has been trying to boost the economy. If you look at the budget deficit target, it's the highest it's been over the last 10 years, but both the market as well as this consumer has shrugged off some of the actions that the government has taken. Now, while the property sector, local government debt, those things continue to be a challenge, you think about valuations, you think about consumer confidence, you think about investor sentiment. Those are at extreme lows. So we think there is upside potential for China in 2024, though certainly there are risks there as well. Now, one of the key risks for 2024 is centered on geopolitics. Both Frank and Catherine have already mentioned this. Now, unfortunately, we're well aware of the conflicts that are happening throughout the world, so those are certainly risks. In addition to that, 2024 is a heavy election year. You've likely seen headlines that say more than half of the world's population is set to go vote in an election this year. So the outcome of these elections can potentially influence market performance. Now, let's summarize the risk and opportunities for non-U.S. equities in 2024. So from an opportunity perspective, EMX China has a lot of momentum. We think that can continue to happen in 2024. Japan is back on investors' radars. And then China, both risk and opportunity. There's a lot of challenges there, but if there is a catalyst, there's some potential value that can be locked in a quick way. From a risk perspective, this idea of expectation versus reality, how will interest rate cuts unfold in 2024, and then certainly a lot of uncertainty throughout the globe related to geopolitics.
Thanks, David. International markets are always so difficult to predict because we have to lump together all these countries and economies and policies. It's difficult to synchronize one singular theme or view on the asset class, but I think this does a really good job of boiling it down to some of the biggest drivers that we'll be watching this year. So let's move now from traditionals to alternatives, and we're going to tee up the alternatives by starting with hedge funds. And Evan, over to you.
Well, first of all, can I just say the fact that Dave Hernandez was born in 1980 is shocking to me. The guy doesn't look a day over 25, but I digress. We'll start with hedge fund performance here, as we always do. So a positive fourth quarter and full year for pretty much every hedge fund strategy type that you see on this slide. So put right strategies led the way for the year with the put right index up just over 14% in 2023. Those strategies typically have higher betas than a lot of other hedge fund strategy types listed on this slide. So when equities are performing strongly, like they did in 2023, put selling strategies tend to be positive as well. There's also the yield component. So the options that are sold in these strategies are collateralized by pools of treasuries. The index listed here uses 1 and 3 month treasury bills. Different strategies do things somewhat differently, but regardless, the fact that yields were much higher last year than in years past was certainly a tailwind for put right as well. You can see that equity-oriented strategies were also strong. Again, of course, higher betas there, so it shouldn't be too surprising that in a year when stocks were up, 20+%, the equity hedge index was up 10. And we'll get into some long versus short attribution in a minute. What else on the slide? So event-driven and merger arb strategies were, I would say, a little choppy throughout the year, but ended 2023 on a high note amid renewed optimism surrounding the deal-making landscape. Again, more to come on that in a couple slides. Maybe the one weak spot to point out on this list was global macro, so down slightly for both 4Q and the full year. Those are often lower beta strategies. Many of which began the year with short rate positions that obviously worked against them as 2023 unfolded. So, on the whole, I would say nothing too surprising here. Hedge funds largely did what they're designed to do in 2023, providing decent upside participation as well as ballast within portfolios. So again, long short performed relatively well in 2023. Net alpha was actually positive last year for the first time since 2020, as you can see on the slide. That was driven entirely by the long side, that is, as short alpha was slightly negative for the year. Shorts notably rallied to close out 2023, so that spread was negative in December, but positive on a full year basis, about a 4 to 5% long short spread for the full year period. And then as far as positioning goes, so gross exposures hit an intra-year high in December at around 200%. Although that higher gross figure, I would say, was more so driven by market impacts, market movements, rather than the deployment of new capital. Funds were actually trimming back exposure throughout the last couple of months of 2023, as they often do to end the year. That being said, hedge funds still came into 2024 with gross exposure levels that I would call elevated, close to the, I guess, top decile or so over the past year or two. And then I thought it would be interesting to kind of quickly take a look at the specific areas of the market that are currently the most shorted by hedge funds. This is data from Morgan Stanley as of mid-December. And you can see that cyclicals, at least at that point, were some of the most out of favor areas. So think airlines, travel, leisure, hospitality, payment companies, et cetera. And then some of last year's beneficiaries as well. So GLP-1 healthcare and AI-related businesses, some of the most heavily shorted as well. So, what does this tell me? I think it says a couple of things about what hedge funds are doing. So number one, they're perhaps expecting some mean reversion to occur And then 2, perhaps positioning for maybe a more risk-off, defensive type environment that sees the underperformance of more cyclical areas of the market. So on merger, arb, and event-driven, the bulk of 2023 returns for those types of strategies came during the last 2 months of the year. So prior to November, those spaces had actually been quite challenged by a couple of different factors. So first, we've had higher rates, obviously. Those have made the financing of new acquisitions quite difficult. And then, of course, the FTC, we've detailed this fairly extensively in previous webinars, but that agency, that regulatory body, was quite active throughout most of last year in terms of challenging deals and then attempting to limit the amount of M&A going on. And, according to Bloomberg, kind of to that point, deal volume last year totaled a little less than $3 billion, and that's the lowest figure in over a decade, and that led to tighter spreads throughout a lot of 2023. Now, that being said, and as you can kind of see on the slide, the tide does appear to be somewhat turning here, I would say, with a couple of notable transactions closing in 4Q, many of which did face some significant regulatory hurdles. So, for instance, you had Broadcom and VMware. That was a deal that closed in November. Pfizer and Seagen closed last month, so those were positives for this space in particular. And then, going forward, I think significant dry powder, as well as more attractive valuations. Those are other factors that could lead to resurgent performance from these types of strategies going forward, though it is worth bearing in mind here that there are still risks facing the event-driven and merger arb spaces. And I think that's actually a nice segue into the risks and opportunities slide that's coming next. So yeah, maybe we can start with that risk and others, and then finish with the more positive stuff. So as far as M&A goes, yeah, the regulatory environment I think is still challenging and uncertain. There aren't really any indications that the FTC is going to be any less aggressive going forward. They seem perfectly happy to continue losing in courts. Interest rate uncertainty is another key risk to this space in particular. And then Frank talked about it. Yeah, Catherine talked about it. Dave talked about it. Greg, you probably mentioned it as well. I wasn't really paying attention. No, I'm kidding. But 2024 is presidential election year, obviously. And that means that we could be looking at a very different regulatory environment in just a couple of months. That creates significant uncertainty as well. Other risks facing hedge funds more broadly, I would say deterioration of fundamentals could be a headwind for various strategy types. And I'm guessing Chad is going to touch on that point during the private credit section of the webinar. Another one, macro-driven markets. So macro obviously has had an outsized impact on markets over the last couple of years. Should these trends continue, you could see strategies like equity long-short struggle, as those types of funds typically have a more fundamental bottom-up focus. And then this is an interesting one that we decided to include this go-round, which is the rise of multi-PM platforms, also known as pod shops. So 5 years ago, there were less than 30 pod shops in existence with around 150 billion in AUM. But if you fast forward to now, both of those figures have essentially doubled. And that's a potential concern for a couple of reasons. So number one, there's obviously only so much hedge fund talent out there. So you could see higher levels of investment team turnover across the industry as a result of the growth in pod shops. Alpha erosion is another concern. There's also the risk of contagion. Since you now got a lot of dollars sort of deployed in a similar fashion, you've got the use of leverage as well here. So if a lot of these shops try to deleverage or exit some of these trades at the same time, that could lead to sharp price swings and losses. So, those are some of the risks. As far as the opportunities are concerned, higher for longer rates, those could serve as tailwinds for specific strategy types. We talked about VRP, volatility risk premium strategies, put-right strategies benefiting from higher yields on collateral pools. Long-short is another area that might benefit from higher rates via more attractive short rebates and an environment that's typically more conducive to short alpha. Credit hedge funds, we think, are potentially in a good position going forward. So the capital structures of a lot of companies right now, as we've talked about, are somewhat vulnerable. So many are over-indebted and facing pressure surrounding repayments, and credit hedge funds, I think, have the ability to kind of go in and exploit some of that weakness in an opportunistic fashion. So maybe some positives there. And then finally, just want to sort of close by reiterating a couple of value propositions for hedge funds in general. So you've got flexible mandates, you've got effective sort of implementation of exposures, alpha orientation, which often lead to stable patterns of performance, at least on a relative basis over time, as well as capital preservation during periods of stress. I would say, kind of circling back to my comments at the onset, funds largely delivered on those value props last year. And I suppose we'll see if the same holds true in 2024. So with that, I think I will turn it back over to you, Greg.
Yeah, and like any year, there's a variety of opportunities and risks that the market faces, and I think we've done a pretty good job summarizing these to point. And for hedge funds, it's can they capture those opportunities and profit off of them, regardless of their underlying strategy and tools that they're using to execute those strategies. So again, a lot to watch for in the hedge fund space. So let's move now to real assets. And Griffin, I think you have the hardest job of anyone on the webinar today, and that's really trying to explain what's really been the biggest detractor from client portfolios this year is real estate, and helping clients understand that it's not real estate as a whole, but really office has been the biggest challenge. And while there are some shorter term headwinds that the asset class faces, the longer term fundamentals are actually pretty healthy, and real estate is likely to remain a long-term constituent of most institutional portfolios. So Griffin, take us through what happened last year and then what you're watching this year.
Yeah, thanks, Greg. Yeah, certainly a very difficult year for real estate in 2023. Last quarter, I spoke about how the low availability of debt and higher debt costs are disrupting capital stacks. And today I'm going to build off of those challenges as they remain, but I'll point to a few other things that I'll be keeping an eye on throughout the year. But before we look forward, I'll begin with performance as we always do. As a reminder, the performance here is as of September, since real estate is lagged, is reported on a lagged basis. Private real estate, denominated here by the NFI Odyssey, contracted by 1.9% in the third quarter, bringing year-to-date performance down 7.6%. Last Tuesday, we did receive preliminary fourth quarter data from NCREIF with the expectation of an additional 4.8% contraction, which would bring the Odyssey down over 16.4% since fall of 2022. Private and public real estate performance continued to converge in the short term, but on a long-term horizon, private real estate has outperformed. One thing to highlight was that there's some positive momentum for public real estate in the fourth quarter, represented by NAREIT on the chart here, with an 18% return in the fourth quarter, effectively erasing that negative 8.3% you see on the page for the third quarter, and contributed to the index being positive for the full year 2023 at 11.4%. Lastly, outside of hotels, property returns across the board are experiencing downward pressure. Office consistently has been the largest detractor at negative 3.7%, but there's also continued softening by multifamily and industrial as well. As mentioned in the last few webinars, fundamentals remain strong for these two sectors, so their decrease in value has been driven more by capital markets rather than property level fundamentals. The denominator effect was a main topic of the second half of 2022 and 2023, as investors found their portfolios quickly overweight to alternatives, which much of the rebalancing to the public markets being fueled by investment dollars within private real estate, managers established redemption queues and have slowly been satisfying redemptions, if at all, each quarter. But now that the S&P has rallied and the Odyssey has depreciated as of September 2023, the effect is somewhat alleviated and investors have shifted more focus towards revisiting the overall real estate target in their portfolio. A main driver of private real estate's slow depreciation descent has been the lack of transactions occurring in the space, with transaction volume being on pace for its lowest in the last 5 years. Appraisal companies rely on these transactions in their underwriting processes. Therefore, the lack of comparables makes it difficult to identify what properties are actually worth. The wall of debt maturities coming due over the next several years, however, will likely force transactions to occur in the market, as there is just under $1.2 trillion of real estate debt maturing by 2025. As mentioned in previous quarters, new loans are charging higher rates for less of the capital stack, so effectively an investor is paying more for a smaller loan. Investors must factor these limitations into their investment assumptions going forward, but for the investors who are well positioned from a liquidity standpoint, the distress in debt markets should present opportunities. But if we rewind and kind of summarize here, it's certainly a challenging environment for investors, but it's important to always remember and remind ourselves of private real estate's performance long term. The chart here shows the 5-year return of the Odyssey Index after periods of significant contraction. Historical data supports that it isn't critical to time the exact bottom of private real estate. Rather, there exists a half-year window on either side of the trough that delivers a comparable return when zoomed out 5 years. Looking at this recovery under a different lens, the Odyssey benchmark has historically provided positive net returns in the quarters following the last rate hike of a Fed tightening cycle. While there is dispersion in the magnitude of those returns, positive performance has occurred in all cycles over the last 44 years. Since we're only 2 quarters removed from the Fed's last rate hike on July 26th, it's still too early to tell and forecast where performance will land at the year and a half from now. But given property market fundamentals have held up relatively strong, an optimist would kind of hold the point that positive returns for core real estate will resume over the medium term. If we switch gears now to the other tangible asset class, private infra, represented by the Burgess Index, was essentially flat for the third quarter, bringing one-year performance to 8.8%. Looking at its relationship to inflation plus 5%, private infra continues to be a diversification tool against inflation while generating a reliable income return. As we can see across 4 different economic scenarios, private infrastructure, represented by the purple bars, has exhibited a much more stable return profile relative to global equities and bonds. It will likely underperform in good economic scenarios, but will outperform in bad ones. One key tailwind I wanted to touch on is the deglobalization push for the U.S. that has been supported by the Inflation Reduction Act and the CHIPS Act. Many large corporations such as Texas Instruments, IBM, and Intel have announced multi-billion-dollar manufacturing facilities to be built in the United States. While these facilities will definitely support real estate as an asset class as well, given the strong demand for industrial, logistics, cold storage, and everything there, large projects like these will certainly command the certainty of infrastructure capabilities involving energy supply, transportation networks, utility services, and high-speed internet. Thanks, Greg.
I think this chart is really important just to explain that there are further tailwinds for the infrastructure asset class, and I would reference the prior slide as well. That infrastructure has a stable performance across different economic environments that can't be set for all capital markets. So that really speaks to the diversification impacts of infrastructure in a portfolio. And then rewinding a bit further to real estate, kind of repeating the comments that we made at the beginning of the section, some more short-term headwinds, particularly in the office space. But longer term, real estate has proven to be a resilient component of portfolios, and we talked about kind of the medium term as the expectation when returns normalize, and that's what we're working with as we move forward. So let's move now to private markets, to the last portion of our prepared comments. We'll start with private equity, and Haley, take us through what you're seeing.
Great. Like Griffin said, for real estate, private equity and venture capital performance is reported on a lag basis. The numbers displayed here are as of 3Q 2023. Global private equity and U.S. private equity were slightly down in Q3. U.S. buyout and U.S. growth were positive, but global was still negative. Venture capital performance had another negative quarter. Venture capital is highly dependent on the IPO market, which continued to lag, and in order for that performance to bounce back, the IPO market is going to need to pick up this year. Private equity is still outperforming public markets on a long-term basis, except for global expansion is slightly lagging. 2023 ended the year with deal activity down from 2021 and 2022 highs, but on track when you look at historical trends. Going into 2024, financing should be easier to come by, which would cause an uptick in deal activity. Add-ons and smaller deals are still a significant portion of the deal activity because platform deals rely on more leverage. There's a lot of dry powder that's going to need to be deployed in 2024. So we're expecting that to drive deal activity. Also, private credit finances a lot of the private equity activity, and there's a lot of dry powder in that space too. Exits lagged expectations to close out the year. We saw some encouraging signs in September that the IPO market was going to open back up, but it slowed again in Q4. Until market conditions improve, majority of PE firms are going to hold onto their companies for longer. With pressures to exit and create distributions for investors, we're seeing an increase of continuation funds, and we're keeping an eye on that in 2024. Another reason why we're expecting deal activity to pick up this year is that valuations are declining. This could potentially create a good buying opportunity for private equity. And like private equity, valuations in venture are still on the decline from 2021 highs. This sharp decline in valuations in the later stage is the factor that's driving the negative performance across VC. Venture capital is definitely facing some short-term headwinds with activity low, but the industry is well capitalized, and segments like AI are going to help build momentum for the asset class.
And Haley, as we revisit some of the themes that we've touched upon with all the sections, we keep coming back to lower interest rates. And then coupled with the lower valuations we're seeing in the private equity space shown on the prior slide here, I think lower rates and lower valuations is naturally going to encourage more deal-making activity and more exits too. So I think investors can probably expect a little bit more net liquidity across their private equity portfolios in the year ahead. And of course, private equity too really is dependent upon private credit to finance a lot of those deals getting done. So Chad, take us to private credit, not only kind of what it did for investors in 2023, but how not only it's going to support private equity, but just as an asset class on a standalone basis.
Yeah, thank you, Greg. And not to sound like a broken record, but like real assets and private equity, private credit performance is also reported on a quarterly lag. So the data you see here is as of Q3. So we've seen positive performance across private credit in the third quarter and also year to date. Within broad private credit, that's the first line there. You can see the third quarter posted about a 1% gain, a little bit north of that, and up 5.8% for the year. Middle market direct lending, which is one of the larger subsets of private credit and focuses on performing middle market corporate loans, posted gains that were north of the broader private credit universe, up 3.2% for the quarter, up about 9% for the year. Now, if you compare that to public markets, and it may be hard to remember this since it's been almost 4 months in the rear view, I know Frank touched on this, but traditional fixed income, the ag, was actually on pace for a negative year in 2023 before a strong fourth quarter pushed those indices into positive territory. So you can see here for the third quarter, the ag was down a little over 3.2%, down over 1% for the year, and again, finishing in positive territory. Importantly, if you compare that with private credit and the stability and the floating rate nature of the asset class, this has really served as a ballast for client portfolios in 2023. And again, I'd expect that to do so going forward. I'll also note we don't have Q4 marks yet, but we would expect similar gains in the fourth quarter with floating rate loans and interest rates being elevated. I'd expect direct lending to have posted north of 10% for the full year in 2023. Now, one of the main reasons why the asset class remains particularly attractive is that consistent yield premium offered relative to traditional fixed income. So you can see on the chart here, the green line shows direct lending consistently over time, offering attractive high single digit to low double digit yields over this period. Now, for most of the period shown on the chart, interest rates were particularly low, as we all know. You can see the proxy there with the 10-year Treasury. And again, private credit has offered superior returns consistently over that period. Now, again, with rates moving higher, private credit was a direct beneficiary. You can see the tick up along with the other fixed income asset classes to something north of 11 to 12% for the most recent period. Now, at some point this year, we would expect rates to come back down. Frank talked about this. The timing and the magnitude of those cuts are certainly in question. But even if rates do move lower, I think investors should safely expect healthier yields going forward in private credit, again, in that low double-digit, high single-digit range. Now we shift gears a little bit and think about some of the underpinnings of the opportunity set and why we continue to favor private credit. Let's start with dry powder in private markets. So you can see here, dry powder continues to build in both private equity and private credit, highlighting some of the success of fundraising in recent years, but also meaning there's a ton of money sitting on the sideline that eventually needs to be put to work. And there's only so long managers can really sit on the sideline. Haley noted this, but deployment volumes were significantly down in private equity in 2023. And by extension, we saw a similar decline on the private credit side with volumes down about 40% for the full year. Now, that being said, I think there are signs that volumes should increase in 2024. We've started to see some signs of that here in early 2024. There are several reasons for that. And I think price discovery between buyers and sellers in the private market seem to be coming more in line as investors and borrowers come closer to terms with the interest rate environment. Some of the macro impacts have stabilized as well. We've also seen LPs really push their GP sponsors to spend some of that dry powder, put money to work, and also generate realizations for allocations that are already in the ground. We've seen a buildup of the pipeline of activity on the private equity side. So I think just combined with those pressures from GPs, I think you should expect to see more volume here in 2024, and by extension should boost volumes in private credit as well. Now, if you look at the next slide here, this is the maturity wall for leveraged loans. And while this is a notable concern for investors in recent years, especially in the face of rising rates, the amount of debt really built, and became an issue as we got closer and closer to that maturity. Now you can see here the darker line, and borrowers have really done a good job pushing out that maturity wall into 2026 and beyond, with much of those pressures sort of abating here in the near term. Now, that being said, most of these refinancings need to occur 12 to 24 months ahead of that maturity wall. And so while it's been really pushed out, there's still 100 billion plus coming due in the next 2 years, and another 175 billion due in 2026. So that'll need to be addressed sooner than later. Now, some of that activity will be refinanced in the syndicated loan markets, but private credit will also take down a portion of this. So again, just another tailwind for private credit markets. Now you can see some of those dynamics at work on this next slide here. This shows private equity LBO financing between private credit and syndicated markets. For the past 2 years or so, private credit has dominated that. Syndicated markets have been largely shuttered. And we've also seen a retrenchment for the banks in their ability to lend to borrowers, just given surrounding regulations, stress on the balance sheet for each of these banks. And a lot of that void has been filled by private credit. Now we're seeing some signs that the syndicated loan market will come back online. I think we should expect that to happen at some point. But there's definitely enough demand out there in the ecosystem that both markets can and will coexist going forward. Now, just turning to underlying credit performance, this is sort of a proxy here looking at default rates. Default rates have been exceptionally low despite higher debt servicing costs as a result of rising rates. In fact, private credit defaults are actually lower, or have been lower more recently than leveraged loans, highlighting again that we haven't seen massive deterioration in fundamentals for private borrowers to date. I think it's safe to assume with the impact of higher rates, and again, the trajectory of rates coming down is uncertain, it should have some uneven impact on borrowers, most likely seeing a modest tick up of defaults in 2024. But that being said, investors are pretty well compensated given where yields are, as I noted. So not a major concern, but something we're watching. Finally, I'll just wrap up my section with some of the risks and opportunities that we're watching here in 2024. Again, I touched on interest rates, the trajectory uncertain, but certainly presents an opportunity with healthy yields today. Now, again, higher debt service costs as a result of those rates could lead to some stress for some borrowers, particularly those over-leveraged balance sheets. The higher end of the market is where I'd see the biggest risk there. I touched on the deal activity pipeline on private equity, bank retrenchment offering opportunities, and again, the refinancing opportunities in the leveraged loan market providing opportunities. Now, on the risk side, we've seen increased competition, a number of new entrants coming into the market, really pushing on terms and tightening spreads a little bit to a degree. That could continue, but still today, I would say terms and yields are still attractive and just something to monitor and watch. And with that, I will pause there and turn it back to you, Greg.
Thanks, Chad. And I think the competition note is important to remind investors of because as more and more strategies come to market, this is a relatively new allocation for most institutional investors. Naturally, managers are going to flock toward those opportunities are, but it's important to really choose managers that have a lot of experience in this space because as credit markets churn and change in more stressful environments, not every manager will live through that. It's important to work with managers who have experienced navigating those types of waters. So again, just a friendly reminder as all of our clients on the call think about doing more in the private credit space. So that's the end of our prepared remarks this afternoon. We do have a few minutes for questions and answers. What we're going to do is we're going to go through the questions that were submitted ahead of time. And just going forward, I want everyone to know that if you would like something addressed on the call, feel free to send that question to me or any of the analysts who spoke on the call today. We'll make sure it makes its way into the queue. But we'll work through these, and I suspect by the time that's done, we'll be right at the top of the hour. And like I said, we are committed to answering any other questions that come in. We will reach out individually to the people who have submitted those questions. But starting at the top here, Frank, this one's for you. I'm curious to hear the team's thoughts on the pace and magnitude of rate cuts this year, and in turn, how the firm is advising its clients to construct their fixed income portfolios.
Sure. Thanks, Greg. So, I mean, I think a few things. Everybody's confident that you're going to see rate cuts this year, although they were also confident that you would see them last year, which didn't come to fruition. I think right now they're probably a little bit overdone, that they're baking in way too many cuts way too quickly. Only time will tell. How we're advising clients to invest, I think a few things. We generally try not to make tactical decisions in our portfolios. First things first is you got to get the strategic asset allocation correct. In terms of fixed income, what does that mean? People are just investing in more fixed income this year. They were investing in more fixed income last year because if you start out with a higher yield, you're probably going to get higher returns looking forward. So I think that's one. And then the second piece is really to hire good active managers and leave that discretion to how you want to position in terms of what sectors and what duration positioning and what curve up to your managers and to implement into the portfolio.
Yeah, I think trying to time interest rates is about as successful as timing the equity market time after time after time. It tends to be more of a loser's game. So thanks for that. Catherine, spend a minute or two talking about how active U.S. equity managers did in 2023.
We occasionally talk about this from time to time, and I think earlier in the year you saw small cap value managers do very well with the banking crisis, whereas large cap managers struggled because of the concentration in the Magnificent Seven. That got flipped on its head a little bit in the end of the year because small cap value struggled more so. We talked about sort of the banks coming back, and small cap value managers tend to be underweight that banking industry relative to the benchmark, which tends to be quite a bit lower quality. And the quality of that benchmark has deteriorated over the last several years. And then you also saw biotech, which we didn't talk about, do very well in the small cap space in the fourth quarter. And active managers, again, tend to not hold much weight in that space. So you saw small cap managers do active managers fairly disappointing in the fourth quarter. Hopefully, if you do see market breadth sort of come back in 2024, maybe you'll see active managers perform a little bit better next year.
All right, David, next one is for you. Given the struggles in China, have clients started looking at EM ex-China strategies?
I'd say that we've had some questions about EMX China, but not very little to zero activity on EMX China. And I think that matches up with what I'm hearing and chatting through with investment managers. They fielded some questions, but not a lot of movement. If you look at flow data, there's not a lot of flow data that's moving into EMX China versus China in terms of active managers. And then the other thing I'd probably note on EMX China is the universe of options currently is fairly small. I ran the data back in November. I think it was around, let's call it 25 options in the investment currently. And then I think about 8 or 9 of them actually had a 3-year track record. So I think probably something we'll continue to monitor it and pay attention to the strategies out there. But as of right now, not a whole lot of activity.
All right, thanks, David. Evan, have we seen an uptake in investor demand for hedge funds given the potential opportunities currently available?
Yeah, so in a word, no. P&I recently released some data that indicated last year was the worst year on record for net new hedge fund mandates since at least 2017. So at least on the institutional side, new investors aren't exactly piling into the space. I will say on the flip side, though, current hedge fund investors aren't exactly running for the exit. So pending redemption levels are in line with historical averages and actually a little lower than they have been over the last decade or two. Part of that might just be the fact that a lot of folks have already decided to pull the plug on their hedge fund programs, but it could also speak to some semblance of conviction in the space on the part of certain investors.
Thanks, Evan. Griffin, 800-pound gorilla in the room. What is your forecast for the recovery of office?
Yeah, certainly. I mean, office is tricky. Certainly is a systemic issue here with the acceptance of remote work and hybrid working. It's certainly going to take some time before we hit the bottom. You sort of draw a connection here to retail post the global financial crisis, just given there was this extreme supply-demand imbalance, and it's certainly going to take some years for that imbalance to correct. It's not a bad across the board. Office built to that post 2010, great amenities, good markets to be in is certainly well positioned going forward. But for those assets that are outside those qualities, it's going to take some time before they hit the bottom there. But certainly opens up some opportunities for those more of those risky appetite investors who could potentially buy into some pretty distressed office assets.
And it's worth noting, too, that there are actually some really well-performing office properties as well. It's not all doom and gloom. So there's a lot of bifurcation amongst geographies and buildings. Haley, you touched on it briefly. What's going on with venture? Are returns going to bounce back?
It's impossible to tell for sure. We expect Q4 to maybe come in slightly negative, but we are expecting returns to stabilize going into this year.
All right, and then Chad, last one's for you. Should investors be considering evergreen products for access to private credit?
Yeah, so in short, we've seen a significant increase in both the demand for evergreen products, but also just the number of products available. Maybe some of that's feedback from investors that managers took to heart and developed offerings. There's a lot of pros to evergreen funds. One, you get better diversification, some more efficiency with the vehicle with regard to optimal return generation before the on the closed-end side, the wind down happens quickly, and so you kind of don't optimize those returns. But one of the benefits, and this is in stark contrast to some of the open-end real estate funds, is that these funds won't be queued. If there's any issue with demand for redemptions exceeding subscriptions in, investors can go into a runoff. So they hold their own securities that will liquidate on their own, and you don't have that risk of your capital being gated and illiquidity sort of being put up in the face of GPs blocking capital out the door.
Thank you, Chad. And by my clock, it is 2:00 on the nose here in Chicago. So we're going to wrap up here. We'd like to thank everyone for spending the last hour with us. We hope it was a good use of your time and give you a little bit more clear vision of what to expect out of markets and what to watch for over the course of this year. If you have further questions, there's an email address on your screen, research5@marquetteassociates.com. You send a question to that audience that goes to the whole team, it will be addressed. So thanks again. Have a great rest of your day and have a great 2024.